Yes, let us start today's revision of the second chapter. Now, unlike the first chapter, second chapter, as you all know, is more of theory and less of practicals. In the first chapter, we had sums to calculate the national income, etc., investment multiplier, GDP deflator, and all those calculations. But in the second chapter, you won't find that many calculations. Yeah, probably one or two that we have done in the classroom environment. So we are going to revise this chapter through our notes, which is available on OneFin. So any of you are watching who don't have these notes, you can get it from OneFin app. You can download it through Google Play, and you can go and download this app and get the notes in the free resources. So let us start. Chapter 2. The name of the topic is public finance, right? And the unit 1 of this chapter. Now the unit 2 has come first. I will just go back to unit 1 and we will start from there. Yes, here we are. I'm very sorry for the small PDF merging goof up that happens all the time. Now, unit 1 of chapter 2 is fiscal functions and overview. Now, what are you going to learn in this chapter? Majorly, the chapter talks about the functions of the government, right? I had told you in the classroom environment that I had given a master example in which we were discussing about the business cycle. And we had told something like this, right? Business cycle looks something like this. And this variation, how much does it variate from one phase to another phase? To calculate that, we need numbers, whether our economy is going up or going down. If it's going down by how much? If it's going up by how much? We need the numbers. And to get those numbers, we calculated the national income, we calculated the GDP, not only the GDP, but there are 8 measures which we discussed yesterday, right? And in the master example, we had discussed about how having these big variations in business cycle is very dangerous for the economy. Hence, we need to smoothen this, right? We have to make sure that these curves or these phases will be short-lived. These phases have to be as short-lived as possible so that economy will be stable and economy will be constant over a time. Now, to make this stable or to make these phases short-lived, we had told that there are 2 different types of policies that country undertakes or country's institutions undertake. One is through the government, which are fiscal functions, and secondly through the monetary organizations such as RBI, right? RBI is the central bank of this country. Hence, the central bank will come up with the monetary policies, whereas the government will come up with the fiscal policies. So here we are going to learn about the functions of the government. What does it do and why does it do what does it do, right? So in fiscal functions, we are going to learn about the 3 major functions of the government, that is allocation function, redistribution function, and stabilization function. From the examination point of view, all 3 can be asked as a short note. So you have to be very careful there. You have to make sure that you know something to write, at least 4 or 5 lines to write about each of the function, so that a direct question might appear. It has appeared in the past and it will appear in the future as well. Now, first, the role of government in an economic system. I gave this short paragraph here just to make sure that if any short note question come again over here, there will be an easy answer over here, right? The basic economic problem of scarcity arises from the fact that the account of qualitative as well as quantitative constraints, the resources available to any society cannot produce all economic goods and services that the members desire. That is one line that all economics students know, that resources are limited and the wants are unlimited, right? That's what we are telling over here. And Richard Musgrave, in his classic book, The Theory of Public Finance, introduced 3-branch taxonomy, that is the 3 functions which we are talking about here, that is the resource allocation, income redistribution for fairness, and macroeconomic stabilization. Now let us first go to the allocation function. What is allocation function? Allocation function, majorly the definition that we have to look at, and the first few lines become very important for your answers if it comes for a short note. Resource allocation refers to the way in which available resources or factors of production are allocated among various users to which they might be put, right? A resource might have multiple uses. Okay, multiple goods can be produced out of one resource. We had given the example of production of wheat, and the poor section or the weaker section of the society wanting rotis, whereas the rich section wanting nice cookies, and what will be produced, right? That kind of confusion we had whenever we had a resource which is scarce and there is a lot of different uses to it. So here resource allocation means precisely how to allocate those scarce resources into the various uses that it has got. Next, the private sector resource allocation is characterized by market supply and demand, right? Whenever you're talking about any private player, okay, any private company that you're seeing on the in India, they will only produce goods and services based on what? Demand and supply. If you just let them, they will not care whether the majority of the people are wanting certain goods or not. They will only produce those goods for which there is demand, whereas the welfare of the country is the sole responsibility of the government alone, whereas the private players will not voluntarily come ahead and make sure that the welfare is attained. It is government's duty to make sure that certain rules are put in order to make sure the private players also contribute to the welfare of the country, right? Now, I have given these several lines over here. If you read it once, you will definitely remember the major crux in 4 or 5 points, which you can write in the examination and you can get marks. That is what we mean by allocation function. Whereas, uh, you know, market failures, which hold back the efficient allocation of resources, occur mainly because of the following reasons. So, what are we reading here? We are reading what holds back the efficient allocation of resources, and what are the, or it can be asked as what are the reasons for not having efficient allocation of resources. And the answer to that is given in 1, 2, 3, 4, 5, 6, 7, 8 points, right? In these 8 points, you don't have to remember all the 8 points, you have to read all the 8 points, of course, but while reading it you will definitely remember 4 to 5 points, and that can give you good enough marks. What is written over here? Imperfect competition. Markets typically fail to provide collective goods which are by their very nature consumed in common by all the people. Markets fail to provide the right quantity of merit goods. We have discussed all these things, and we are going to discuss in the future. It's going to come what are merit goods, what are public goods, what are quasi public goods, etc. Whereas common property resources are overused and exhausted to individual pursuit of self interest, right? And externalities, factory mobility, imperfect information, inadequacies in the distribution of income and wealth, or inequalities, sorry, in the distribution of income and wealth, etc. There are, like, very general point. What makes sure that there is no efficient allocation? What are the reasons for not having efficient allocation function? These are the types of questions which are possible in the exams, where you have to remember the 4 points. Okay, and 4 to 5 points. Why I say 4 to 5 points when there are 8 points? People usually ask me why I have to remember only four. But if you look at the question paper of economics for finance, usually they don't go beyond asking questions for 3 or 4 marks. They won't go beyond it. If they go beyond, that question is usually the GDP calculation question, right, which we have done in the first chapter. So whenever they are asking these short questions, or the questions for lesser marks, such as 2 marks, 3 marks, or 4 mark question, they won't expect you to write all the 10 points or 8 points which are there, right? You have to write proportionally, because first of all you don't have time. Whenever they make sure that 3 to 4 mark questions are asked, these questions will be plenty, right? You have to answer them all, right? Only one or two choices will be there. And if you keep on writing all the points, then you will not have time for the rest of the question. So you have to make sure that you write those 4 points or 5 points and come, right? You want to write one extra, you can do that, right? But the marks will be allotted based on what you write. Next, the allocative or allocation function in budgeting determines who and what will be taxed, as well as how and on what the government revenue will be spent, right? So basically in allocation function, what do we do? To allocate, first of all, I need resources. So government will decide from whom I should get the resources, of course, through tax revenue. So government will decide where to collect tax, right? Where to collect tax, that is also very important question in front of government, because you can't take tax from all the people, right? You can take, but that won't be fair, because there are people who are earning in lesser slabs. There are people who are earning exuberantly in thousands of crores, right? You can't tax them the same. That is not possible. That's why we have slab rate where up to 2,50,000 you don't have to pay, and the rates follow after that, right? That reason is there because they don't want to tax, right? The people who are earning less money. We call that progressive taxation, right? At the same time, differential taxes are charged in indirect tax, right? The necessities are taxed at a lesser GST, whereas the luxury items are charged at higher GST, right? That kind of decision government will make, that is where to get the money from. Secondly, government will also do something called as where to spend the money. That in the previous months, you have seen that in the budget, that's what it is all about, right? Where to spend the money, right? Where to get the money and where to spend the money. That is nothing but the allocation function that we are talking about. A variety of allocation instruments are available. Allocation instruments means how do we do efficient allocation of resources? And this can be a question, again, a 4-mark question, which is possible over here. Now, here we have given several examples, right? Government may directly produce economic goods and services, and it can produce. See, if it's leave to the market, some people will not have food. Weaker sections of the society will definitely not have food because private people will run for profit, right? So government will directly produce and supply economic goods and services. And it can be electricity, public transportation service, or you might have seen the fair price shops, right? Which are set up by the government, where you get rice. If you are below the poverty line, you will get a certain kg of rice at a very less price every month, and all those things. That is called as government directly supplying to them, right? Government may also influence private allocation through incentive and disincentive. For example, tax concessions and subsidies. If you put up your manufacturing entity in a backward sector, you will get a additional depreciation. You will get tax holidays. There are so many things you have read in income tax. That is where incentive is given for private players to make sure that there is proper employment and job generation in the backward regions of the country as well. Government may influence allocation through its competition policies, merger policies, etc. Government's regulatory activities such as licensing, controls, etc. Government sets legal and administrative frameworks. Any mixture of the intermediate methods may be adopted by the government. So there are so many points over here. Again, you have to remember around 4 to 5 points, and you have to write it if this question appears. And this question will be what? It will be, what are allocation instruments which are used by the government to make sure there is efficient allocation? That kind of question might appear. Let us go to the next function. The next function is going to be redistribution function. Now, whenever I'm doing this revision lectures, if you happen to have any doubt, what you have to do, immediately go to that comment section and you put up your doubts there. And as and when I see those doubts, I will answer them for you, right? Next, let us go to redistribution function. Now, what is the redistribution? See, in the previous let us say 1 or 2 decades, there has been tremendous expansion in economic activities, resulting in enormous increase in the aggregate output and wealth. However, this wealth has not been evenly distributed among all the people. There are only few people who are getting rich and richer, but there are a lot of people who are getting poor and poorer. Definitely, there are people who have been brought up from the poverty line as well. And there are also people who have been pushed to the poverty line because of the issues which they face in the economy. Now, however, the outcomes of this growth have not been spread evenly. That's what I said. And the distribution responsibility of the government arises from the fact that if it is left to the market, the distribution of income and wealth among individuals in the society is likely to be skewed. And therefore, the government has to intervene and ensure there is desirable and just distribution. So, in distribution function, the government aims at, that is the next paragraph, which means what are the aims of distribution function? That could be the question here. What are the aims of distribution function, right? So redistribution of income to achieve equitable distribution of societal output among the households, advancing the well-being of those members of the society who suffer from deprivations of different types, providing equality of income, wealth, and opportunities, providing security for people who have hardships, and ensuring that everybody enjoys a minimum standard of living. Now, these are the aims. Okay, through distribution function, what does the government want to achieve? That kind of a question can be answered like this. Now, all these points, if you remember in our classroom discussion, we used to call all these points as idealistic points, right? These idealistic points remain common among all the idealist, kind of a question, such as what could be the aims of this function, why government does this, and all these things definitely the points will be either these or similar to this. So we have to just read these points, and definitely you will remember 4 or 5 points. Next, a few examples of redistribution function performed by government. Okay, so here we are going to see some examples of redistribution function. Again, you have to be very careful when you're reading this line before the paragraph, right, or before the points. That line will have what could be the question, right, based on this paragraphs. Sometimes what do, we don't read this line at all, we don't read this, right, we directly go to the points and we read the points, we try to remember the points. At the end of the day, they will twist the question and they will give, and you will not understand where what to write for you know what to write for that particular question, because you have not understood the question. And more than economics, at least economics is understandable when it's read from a standpoint of a commerce student, but these kind of mistakes are usually done in EIS, if I'm right about that, right? EIS, the problem is people don't read that line. If you don't read that line before the points, then you won't be able to answer the questions which are asked in the exam, because they're always twisted. Going forward, what are the few examples? Okay, first example is taxation policy of the government, whereby progressive taxation of the rich is combined with the provision of subsidy to the poor households. We already know that. Next, proceeds from progressive taxes used for financing public services, especially that benefit the low income households, such as essential food grains at a highly subsidized prices, etc. Employment reservations and preferences to protect certain segments of the population, unemployment benefits and transfer payments to provide support to the underprivileged, dependent, and physically handicapped. Families below the poverty line are provided with monetary aid, uh, or aid in kind. It could be food items, or it could be money, or it could be some kind of a pension, right? Old age pension, and a lot of other things. Regulation of manufacture and sale of certain products to ensure health and well-being of consumers. You might have take the example of how alcohol is banned in several states in India. Then special schemes for backward regions and for the vulnerable sections of the population, which I've already told you about. Next, the third function. Third function is what? Stabilization function. The stabilization function is one of the key functions of fiscal policy and aims to eliminate the macroeconomic fluctuations arising, right? You won't like if there is high variation of prices every day, right? Nobody is liking the fuel prices going up every day, or nobody likes the LPG prices going up every day. Although the situations, even if they are out of your hand, out of government's hand, nobody likes the economy being destable, right? So everybody wants stabilization, and it's government duty to make sure that stabilization is kept intact. The stabilization function is concerned with the performance of aggregate economy in terms of, that is, what does stabilization function aims to achieve? Again, it's the aims kind of a question, right? What they want to achieve: labor employment and capital utilization, overall output and income. That is, they want the performance to be increased in these sectors. That is, general price levels have to be maintained, balance of international payment has to be achieved, and the rate of economic growth has to accelerate, right? These are the aims. Government's fiscal policy has two major components which are important in stabilizing the economy. First, an overall effect generated by the balance between the resources government puts into the economy through the expenditures and the resources it takes out through taxation, charges, borrowing, etc. Right? Government gives in one hand, government takes in another hand, right? There has to be a balance between the both. Secondly, a macroeconomic effect generated by the specific policies that it adopts. Every policy that the government adopts will have a rippling effect in the economy, where a lot of things will change based on one policy, and you have to make sure that you have that wavelength handled, right? So next, we are going to the second unit, right? I will quickly glance at the chat box. Good that there are some responses which are coming in Zoom as well as YouTube. Yeah, notes, Raghav, it's available in the free resources. You can either get it from the website, or you can download the app OneFin and you will get it over there. I will go to the second unit. As time is of the essence, I don't want to spoil your time as well, right? It's the last moments of the exam, and you have to make sure that you stay on track as much as possible. Second unit is market failure. What is market failure is the most favorite question of the examiner, right? It is a question which can repeat so many times. We will not, be surprised, because that is one of the important question and important concept for a student to understand. So first, let us understand what is market failure. Market failure is a situation in which the free market leads to misallocation of society's scarce resources, in the sense that there is either overproduction or underproduction of particular goods and services, leading to a less than optimal outcome, right? So what happens here, if you cleanly go with the demand and supply, sometimes demand might come for a product which is actually not a good product. For example, if you give a free rein to let us say alcohol industry, right? And what is going to happen, there is going to be a complete overproduction. There's a lot of addiction in the society, and with that, the quality of the life who are dependent on the addict will fall, and there are a lot of uh, welfare problems which will arise in the country, which the government definitely has to control. Everything you can't say demand and supply, let it decide, right? And sometimes such decision, if it is detrimental to the interest of the country, then such decisions have to be controlled, or government has to intervene, right? That is what we are talking about. When free choices such as demand and supply, or the free forces, lead to misallocation of society's scarce resources, then that situation is called as market failure. And what are the reasons for market failure? Why do markets fail? There are four different reasons. One is market power or monopoly. We know it in the terms of monopoly. Externalities, public goods, and incomplete information. Market power, as I told you, wherever there is monopoly, there is it's not possible to have a healthy market where there is monopoly, because one giant will crush all the other competitors because they have a lot of power, right? Next, externalities. We have discussed this with the example in the classroom. Here I will just tell you what are externalities. Everything that we do will have a positive effect or a negative effect on somebody else, right? That is, even if you like let us say you polluted a river, right? That will have a negative effect on the people who are using the water from that river, right? But you are only paying for your manufacturing cost. You're not paying for the polluting the river, which will potentially disturb somebody else, right? So externalities talks about that concept where you doing something might benefit somebody indirectly, or you doing something might impose a cost on somebody else, right? These things are called as externalities. Now here it is written, anything that one individual does may have at the margin some effect on the others. For example, if individuals decide to switch from consumption of ordinary vegetables to consumption of organic vegetables, they would, other things equal, increase the price of organic vegetables, isn't it, right? So it will have an effect on somebody else. That's what externalities mean. And these are also called as spillover effect, neighborhood effects, third party effects, or side effects. Okay. Any kind of question can be asked. Okay, they can just tomorrow in the exam ask what are neighborhood effects. You should be able to answer and know that externalities is what they're asking. And externalities can be positive or externalities can be negative. For example, if you take a COVID vaccine, the externality is positive. That is, through you, somebody else might not get infected, right? So that is a positivity that you're leaving. So externalities can be positive or it can be negative, and it can be with regard to production or it can be with regard to consumption. I have given this very short notes with regard to that. All you have to do is just go through that. Negative production externality, positive production externality, negative consumption externality, and positive consumption externality. I have given the example in the paragraphs as well. Next, the concept of private cost and social cost, right? Just to put that into perspective, let us take a small example. Imagine that you are having a chemical factory where you are manufacturing, let us say, some chemical called as ABC. You are producing chemical ABC, and for that purpose, you have put up a factory. You have put up a factory, and you're working, a lot of hours. And from this factory, you are leaving the effluents to the river, right? You are leaving the effluents to the river. Now, what is happening over here? When you are preparing your financial statements, you are under the cost, right? In the debit side of the P&L, what are you going to put? you are going to put the cost of raw material, cost of labor, cost of overheads, and all the other administrative expenses, selling expenses, marketing expenses, advertising expenses, all kinds of expenses you put. But because of you polluting this river, some people down the line over here, right, they are trying to drink this water or try to use this water, right, for their day-to-day activities. They are getting affected. But are you paying anything for them? You're not paying anything for them. You're just recording on your debit side of the profit or loss account. You're just recording your raw material, labor, overheads. That's all. You're not recording the damage that you're doing for others, right? So if you just record whatever you actually spent, that is your financial statements, that cost is called as private cost. But if you add the cost that you're imposing on these people, then after adding that, it will become social cost. So private cost and the cost that you're imposing on others, that we know it as external cost. We know it as external cost. We will get social cost. In the classroom, we have discussed it with a very elaborate example. We have taken almost 1 hour to explain what externalities are, right? So here I told you in a short form what is going on. So private cost means the cost which you actually pay. The cost basically what comes up in your P&L, right? And social cost is when you add external cost to it. That is the cost that you're imposing on others. That is when you get to your social cost, right? So I have given the small definition over here. Social cost, what does it refer to, right? Next, let us go to, yes. So social cost is equal to private cost plus external cost, which I already told you. Then we have marginal private cost, marginal external cost, marginal social cost, marginal private benefit, marginal external benefit, and marginal social benefit. What are these all these terms? I will tell you in one explanation so that you will have complete clarity, right? See, whatever that I spend for my regular operation activity, let's take the same example, right? I told you that it is going to be my private cost, and the cost that I'm going to impose on somebody else, right, indirectly, that is called as external cost. And when you add private cost and external cost, it will become social cost, right? Next, what is private benefit? Private benefit, what is the private benefit for the company that I just mentioned? The private benefit is the revenue that they receive, right? The sales that they receive, that is going to be the private benefit. What is external benefit? External benefit is the benefit which is the induced on somebody else because of your company. For example, see, I gave you this example of this company, right? Your chemical company ABC. Now I showed that company as a villain, isn't it? Right? They're leaving the effluents to the river, and somebody else is using that water, and they're getting sick or whatever it is, right? At the same time, chemical ABC, chemical company, also employs, let us say, 5,000 people, right? And 5,000 households are getting that livelihood because of this company, right? That is a dilemma again. At the same time, 5,000 people, out of that, so many people will be trained and they're upskilled, right? Because of your company, they can now get a better job. They can apply for different companies. They can get a higher salary, right? You're adding so much to their life. That is a benefit that you're adding, right? Everything that you do, as we told, it will have a positive effect. Also, it will have a negative effect. You have to look at the positives also. Now, when you're concentrating on those positives, right, we call that as the external benefit. And when you add private benefit with external benefit, you will get social benefit. Okay, it's as simple as that. And how to write it in the exam? I have given here in one line, which you have to remember, right? Next. Yes. So it's obvious that if externality is present, then social cost will not be equal to private cost, and social benefit will not be equal to private benefit, because there is external cost and external benefit, which is the difference between that, right? So it is not possible to get at a equilibrium by just having the calculation about private benefit and private cost. It is not able to have we will not be able to have a proper equilibrium. So here it is, a graph is given. I have taken that from the textbook, right? On the x-axis we are having output, y-axis we are having cost and benefits, where marginal private benefit is this curve, right? And marginal private cost is this curve, and we have obtained the equilibrium at point E, right? which is wrong because your private cost doesn't include the cost imposed on others, right? So you have to make sure that even that cost is included. And when you include that cost, it will become marginal social cost, and a new equilibrium is formed over here in the E1, right? So what happened here? The quantity fell from Q1 to Q2, where the price increased from P1 to P2. Right? This is what happened when you impose cost. Now, how will you impose cost? Of course, if a company is creating a lot of external cost, then you have to tax them. If the company is creating a lot of external benefits, you have to give them subsidy. That's how it works. Next, we are going to the third reason, that is, public goods. Yes. The definition of public goods. Paul A. Samuelson, who introduced the concept of collective consumption goods in his path-breaking 1954 paper, The Pure Theory of Public Expenditure, is usually recognized as the first economist to develop the theory of public goods. What do you mean by public goods? A public good, also referred to as a collective consumption good or social good, is defined as one which all enjoy in common, in the sense that each individual's consumption of such good will lead to no subtraction from any other individual's consumption of that good. This is what you have to write in the examination. If they ask a question, what do you mean by public good? So whenever I'm saying the examination questions, what is a possible question, you have to make sure that you take a note there, right? If you have a notes, you just write down those things which I'm telling important. There's a high probability of those questions coming in the examination. Before we go on to discuss the distinguishing features of public goods and how they differ from private goods, it is pertinent to understand what private goods are. And private goods, we already know, private goods are the goods that we enjoy. We say that they are excludable, right? And they don't and they are rivalrous. What do you mean by excludable and rivalrous? These words you have to remember, because we have used these words like 1,000 times in the classroom scenario, and I'm sure that you are remembering what you mean by rivalrous. That is, if you purchase a private good, right, it prevents another individual from consuming it. If you buy a car for yourself, somebody else can't just come and open the door and start driving it, right? You will have the key and you will have the complete possession. That is rivalrous. If you buy something, somebody else can't consume it. At the same time, it is excludable. What do you mean by excludable? If you purchase, okay, something, you can exclude somebody who has not purchased or not paid for the same item. That is, if you go to a theater with a ticket, a person without a ticket cannot enter, right? Only if you are paid for it, you will be allowed to come inside, right? And it doesn't have a free rider problem. What is a free rider problem also we have seen in the classroom scenario, and I've given it in the next paragraphs. What is a free rider problem? Next, we will come to the characteristics of public goods. Public goods means the goods which are essentially collective in nature, right? Where everybody uses. For example, you can say the light you derive from the street light, right? So that example is given here. That is, for example, if you walk on the street light, the other person too can walk without any reduced benefit from the street light, right? Street light won't say that I will give you more light and somebody else I will give less light. That kind of thing is not possible, which means public goods are non-rival in nature, right? They are non-rivalrous. Next, public goods are also non-excludable, which means for example, national defense once provided, it is impossible to exclude anyone from protection, right? Our armies are there in the borders protecting us. You cannot say that, okay, one, two people from Karnataka we will not protect, right? Once the army is deployed, everybody is protected, right? They are non-excludable. Public goods are categorized by indivisibility. That is, a lighthouse, a highway, an airport cannot be consumed in separate units. It has to be separate, collectively utilized. And I have given several other points, and I have given this example table over here, which we can you can go through later. And I have explained in each category what happens, right? And the meaning of it we already know. And there are something called as pure and impure public goods, which simply means that you take the example of a defense, right? Earlier I used the defense example to say that they are non-excludable, but here there is something that if armies are mostly deployed in the northern borders, right, it may not result in the same amount of protection to the people in the south, right? That is the example. Even in the institute website, the same example is given. What does that mean? That a pure public good is not possible. That's what the author wants to convey, right? These pure public goods, which are usually not seen in the world, the goods which perfectly satisfy the non-rivalness and the non-excludability are not so easy to come across. That is why most of the public goods we call them as impure public goods. Okay. Now, in impure public goods, again, there are club goods and variable use public goods, which the example as well as the paragraph 40 ought right I have given over here. Right. Next, quasi public goods. What do you mean by quasi public goods? A certain private good, but if you take that, the benefit will be given to everybody else. It will act as a public good once you consume it. The best example is vaccine, right? COVID-19, the amount, the moment that you take the vaccine, what is going to happen? The After you take the vaccine, you will protect others from getting infected through you, right? That is going to happen. So the approach, the classification of impure public goods focuses on the mix of services that arise from provision of the good. For example, if one gets inoculated against measles, if you take measles vaccine, it confers not only a private benefit to the individual, but also an external benefit because it reduces the chances of getting infected of other persons who are in contact with him. And there are common access resources such as your rivers or common pastures, seas and backwaters, biodiversity, forests, etc. All these are common access resources. And closely connected to that topic, there is a tragedy of the commons. That is what happens to the common. I have given the pasture land over here, right? What is happening in many of the European countries? This happened whenever they were rearing a lot of cattle, right? And they left this cattle in the lands where there is a lot of like grass, and because of overly using those common lands, soil erosion happened and a lot of other problems happen. That is called as tragedy of the commons. That is, these common access areas, if you keep it uncontrolled, the people who are going to use it for the self interest, and there's going to be a depletion of those resources. Next, global public goods. We have put up global public goods such as are those public goods with the benefits or costs that potentially extend to everybody in the world. These goods have widespread effect on the different countries and regions, population groups and generation through the entire globe. It may be final public goods such as outcomes such as ozone layer preservation or climate change prevention, right? All these kinds of, they might not be goods, they might be some kind of a movement itself, but they're categorized as final goods over here, where if the world fights for ozone layer preservation, or if the world fights for climate change prevention, then it will benefit everybody in the globe, right? Entire world will benefit from it. And intermediate public goods, which contributes to the provision of public goods such as international health regulations, etc. Right? Why it is important to have international health regulation? We just experienced 2 years before what happens if we don't have strict international health regulations, isn't it? From one country, people will carry their infection to the rest of the world, and everybody will sit inside the home for lockdown, right? That's what happens when there is no international health regulation. So global public goods are very necessary for the public. And there are a lot of others, 5 areas of global public goods which it seeks to address. The World Bank. Yeah, this can come as a short question of 3 or 4 marks. Okay, and these 5 points can be easily read and understood. And the free rider problem I have given over here. Here you can see this person is a free rider, right? Somebody else is working and this person just sitting and chilling over there, right? That person is called as free rider. He is a person who benefits from something without expending effort or paying for it. In other words, free riders are those who utilize the goods without paying for their use. For example, imagine that you have a toll road in your vicinity, right? There is a toll road which is built by the government, but there is a toll station over here which you have to pay 80 rupees. So what people will do, people take a bypass which is going through the village, and village will have a small tar road which was very good before. but now all the big vehicles are going through the star road and they're spoiling that road, right? These people who are going through that road without paying for the toll are called as free riders in general parlance, right? Then we have incomplete information, that is usually whenever we buy medicine, right, the side effects is not usually written on the table. They just say that contact your physician before you take this medicine. They will not say what happens, right? So sometimes the information is not given to the public. When information is not given, right, often the demand will go for the wrong items, right? So people will demand for the wrong item because they don't know what is harmful about it, right? At the same time, there is something called as asymmetric information. What do you mean by asymmetric information? See, for every transaction, there is a buyer and the seller, right? And the buyer and the seller both should have the same information, right, before the transaction happens. If buyer knows something more than the seller, or seller knows more than the buyer, then this situation is called as asymmetric information, right? So I will tell you, imagine that there is a farmer who wants to sell his land because he can't work anymore. He has 5-acre land and you are the buyer, and you know that under his land there is some kind of a mine, right, some kind of a metal which you can sell, and the farmer doesn't know. He is going to give it to you at a throwaway price, and you're just having that information inside. And this situation, the demand and supply, they are not free of information, right? There is asymmetry in the information. Next, there is adverse selection. What is adverse selection? It is a situation in which one party to a contract or negotiation, such as a seller, possesses information relevant to the contract or negotiation that corresponding party, such as a buyer, does not have. This asymmetric information leads to the party lacking relevant knowledge to make suboptimal decisions and suffer adverse effect, right? So you don't know, right, a certain information. With that, you will make a decision, and that decision will backfire and you will suffer greatly. That decision will be suboptimal. That's what happens when there is an adverse selection. I did not know, right, about this side effect, but I bought these medicines and now I'm suffering. It is suffering through adverse selection. Next, there is moral hazard. What is moral hazard? Let me tell you in a simple example. See, if you have a 10 crore rupees life insurance, then you will be more confident to do adventure sports, isn't it? Because if you are the sole earner in the family and you're also a adventure enthusiast, if you take a 10 crore life insurance, you will be more than happy to adventure more, right? You will take more risks, and that is called as a moral hazard. It is whenever it is about actions made after making a market exchange, which may have an adverse impact on the less informed person. If you take a car for rent, you are going to rev it without any problem. If your own car, then you are going to accelerate it in a very stable way. But if it's a rented car and you have already paid for kilometers with the fuel, then you are going to burn the fuel as much as possible. You are going to use that car more, uh, firmly, right? That is another moral hazard which we look at. So these are the points with regard to the second unit. Any doubt in the second unit, please put it up in the comment section. I will try to answer as much as possible. Now, before I go into the third unit, I will just have a look at the chat box. Yes, students, definitely that is our purpose of doing the revision classes, that you all must clear the examinations. You should have the best preparation before you go into the examination. Right. Now, we learned about the market failure and the various reasons for market failure. If you can remember, market power or monopoly, externality, and the asymmetry in information or incomplete information that we talk about. And there are so many sub reasons that we learned as well, right? And after that, now in the third unit, we are going to learn about the government interventions to correct the market failure. What can the government do to correct this market failure? So government will have these many things to do. First, they have to minimize the market power. Now we learned that how market power is bad, that is how monopoly is bad. And to make sure that monopoly doesn't happen, we have an act called as Competition Act, where it is amended in 2007 to make sure that the competition is fair and square, right? So that is how government will try to make sure that monopoly doesn't exist in the economy. Then government intervention to correct externalities. How to correct the externality? It is fairly simple. We have already learned this, right? I don't have to explain this section. I will just explain to you like this. See, externality can be corrected in these ways. Imagine that there is a company which is producing a lot of external benefit, when you're producing a lot of external benefit, you have to give them subsidy and make sure that their revenues grow for the benefit that they are giving to others, right? So example, if there is an agro tech company, that is agricultural technology, right? In India, the majorly the farmers depend upon rainwater and whatnot, right? There is a lot of problem even from the droughts, or let us say, or the floods. There is a lot of problem for farmers. So if you bring up a agricultural technology company, and if you try to increase the output of agriculture, make farmers life better, then definitely you are giving a lot of external benefit, and you do deserve subsidy, isn't it? So the government has to come in, and for the external benefit that you're creating, government has to give you subsidy. At the same time, if you are a company such as a chemical company or a petrochemical company, where you're creating a lot of pollution, and you can't shut it down also, because there is demand for the product. At the same time, you're creating a lot of external cost. At that time, what can the government do? Government can increase your cost, right? How government will increase your cost? They will make sure that they'll tax you enough to make sure that you pay a right amount. If you look at the items like alcohol, cigarette, petroleum, the taxes are extremely high. Why do you think? Because the external cost imposed by these items is huge, right? So government wants to compensate that, so they're taxed at a very higher rate. That's what is being learned in this section, right? And we have learned about these pollution taxes, and if the demand for the good is inelastic, the tax may not have a insignificant, or it might have an insignificant effect. See, this is one thing that I wanted to note down from the previous discussion. See, whenever negative externalities are present, the welfare loss of the society, or the dead weight loss, would be in the in our graph, it was in the shaded area. Whenever you have time, just go through that graph. It is not important for you to go through the graph. You have to understand the concept that is more important here. What they are trying to say is that whenever there is a negative externality created by a company, government will impose tax on them, right? Once the government imposes tax on them, then what happens? Whether that pollution tax that you're charging on the companies, whether that is effective or not, that is the question which is asked secondly, right? So let us answer that question now. There are problems in administering the effective pollution tax. That I agree, because first of all, to identify which company does the maximum pollution, it's very difficult, because it involves complex scientific calculations to understand how much air pollution is done, how much soil pollution is done, because you can't tax them all at the same rate. You have to first identify who is the biggest polluter, right? The biggest polluter will pay the biggest fine, right? And how do you understand who is the biggest polluter, right? That is the second question which is in front of us. Next, what they're saying is that pollution taxes are difficult to determine and administer, because it is difficult to discover the right level of taxation. How do you know? Today you might think that a certain chemical company, today you are charging them, let us say, 50% of extra taxes for the external cost that they're producing. But after 20 years, you came to know that the damage was even deeper. Actually, they were polluting further, and because of that, so many people got sick in the later stages. So many children are having problems at birth and all that, right? You discovered it only later. There are so many things which have happened in the past, isn't it? Whereas it was said that the industry existence is completely safe, and it amounted to a lot of health issues for so many people, right, in the country or in the city, right? So it is very difficult to discover the right level of taxation, how much to charge them. We don't know. If the demand for the good is inelastic, the tax may not have may have an insignificant effect, or it might not have an effect at all. Example: petrol prices. You increase the prices, doesn't matter, because people need to go from one place to another place. Yeah, probably some fraction of the population might switch to public transportation, but how many people that who own a car or a bike have kept the car and bike at home forever and started taking public transportation? I have not seen that, right? And you might even argue in terms of they will buy electric cars, but you should understand that electricity is currently produced in a higher extent by burning coal, right? Electricity is not produced cleanly, and until electricity can be produced cleanly, that sector cannot move forward by reducing pollution, right? So it will not amount to much of change. That's what this point is saying. The method of taxing the polluters has many limitations because it involves the use of complex and costly administrative procedure. I told you, right? To understand the air pollution done by a company, you need to have so many scientific methods in which you calculate it. Plus, there should be somebody from the government who verifies this calculation, right? Which means he has to be an expert too, which means you have to hire an expert. It will involve cost, it will involve administrative procedures, etc., etc., right? It will make it even further difficult. The method does not give any genuine solution to the problem. It only establishes an incentive system for use of methods which are less polluting, right? So what will people do? Industries do? They'll just try to reduce the pollution as much as possible, but it will not eliminate the pollution. That's what they are telling, right? And it will also have potential negative consequences because if a company is being taxed at a very high rate in India for polluting, and if some other underdeveloped or very early developing country is offering them lesser pollution tax, they might just move from this country to that country. They're saying that I can't pay so much tax. I'll go to country some other XYZ company where they pay where they allow us to pay lesser amount of tax, right? These are all the things which you have to keep in mind. And there are something about tradable emission permits and all that. That is, you are giving a permit to pollute, and if you pollute above that particular limit, then you'll be taxed at a higher rate. Where if you're below, then you can sell these permits, right, to some other firm which is in need of it, right? So that kind of possibility is also possible. That is tradable emission permits. I've explained it properly over here. You can just go through it. Next, some advantages which are claimed for tradable permits which are given. It's an important question. Let us say 3 to 4 marks. Okay, question it is. I told you what is tradable permissions, right? Tradable permits. That is nothing but, see, rather than restricting you, I'll give you license to pollute. But I'll give you license to pollute within which if you pollute only that much, then you will pay a lesser amount of pollution tax. But if you go above it, you will pay a hefty amount, right? So everybody will try to be below that limit, right? So I can give easy example which you would understand, not very appropriate, but you might have known about this cars having this BS4, BS5, BS6 engines, right? That has got more to do with how to reduce the emissions, right? How to reduce the harmful emissions of the engine and all that. So here what happens, the government will put a prescription and say that please be below this limit. If you're above this limit, we'll tax you exuberantly, right? So if you're below this limit, then the remaining limit what you have, you can sell it to some other company, probably a Honda company. Let us say they were much below this limit, right? Whereas Tata wants more limit, but government doesn't give, right? So you can sell those limits, right, to Tata and make sure that both are having a transaction where you can sell it for money, right? It is definitely for a price, right? These are the things with regard to tradable permits and the advantages, because they are flexible, and the cap puts a clear upper limit on the quantity. Nobody can pollute above that particular limit. The market for permits enables clear price for pollution and helps internalizing the cost. And then it is administratively cheap and simple to implement. And it also provides strong incentive for innovation and to combat pollution. Now, the arguments there are in opposition also, which you can read, right? And 2 to 3 marks question can come. And going to the next concept, this is not this I've already explained to you. That is, if a company is creating a lot of external benefit, then you have to make sure that their revenue rises. If you're into agricultural technology company, you're adding a lot of external benefit, the government has to give you some kind of a subsidy, right? So that those things are written over here. And then we have government intervention in case of merit goods. What do you mean by merit goods? I've given examples: see, education, healthcare, welfare services, right? Fire protection services, and all these things. If you leave it to the private people, they will not produce it. Yeah, private people do produce education, right? But it will be at a very profit intensive, right? It is not for the benefit of the people. It is for the benefit of the individuals who are putting up these educational institutions, right? So government has to make sure that these merit goods are produced in higher quantities to cater for the needs of all the people, right? What are merit goods? Merit goods are the goods which are deemed to be socially desirable, and therefore government deems to have the consumption should be encouraged, right? Next, I have given several points with regard to that. Reason for the government provision of merit goods, right? Because individuals may not act in their best interest, right? If you just tell all people that polio vaccine, if you want to take, you take, or else forget it. Half the people will forget it. You have to make it compulsory. Only then people will take, right? If you had just told that COVID vaccine only if you feel necessary you take, or else you don't take, we will still be in lockdown, right? So the thing is, individuals may not act in their best interest all the time. So you have to make sure that you give that option to them, right? Next, equity considerations demand that merit goods such as health and education should be provided free of cost on the basis of need, isn't it? I always hold this view that education should be free, education should not be paid for, right? And all those things. Whereas acquiring skills can be paid for, right? But the basic education is what we are talking about. If at all a kid has to go through the primary education by paying lakhs of money, that doesn't ensure social welfare, right? If you want to acquire some professional degrees or professional skills and all that, that definitely will involve a lot of cost, whereas basic education will not. Next, due to uncertainty about the nature and timing of healthcare required in future, individuals may be unable to plan their expenditure and save for their future, isn't it? Right? How many people that are the regular savers, right? Who save money? There are a lot of people. There are so many unexpected expenses which might come in the future, for which you need to be ready. And if you just leave it to the people, they will not be ready, right? So that is what government tells us, right? Then I have told you some things about insurance and all over here, which definitely you can go through once I have covered the important parts in that topic. Then government intervention in case of demerit goods. What are demerit goods? Demerit goods are the goods which are socially undesirable. Example, cigarettes, alcohol, intoxicating drugs, etc., etc. Right? All these things have to be produced less and less, right? And its consumption also has to be curtailed, right? Now, how do government correct market failure resulting from demerit goods? First thing, government may enforce complete ban on demerit goods such as intoxicating drugs. There is a Narcotics and Psychotropic Substances Act in India, which makes it illegal to consume or trade in certain drugs. Then, through persuasion, is mainly intended achieved by negative advertising campaigns. Every time you watch a movie, you see that advertisement of don't eat pan parag, or don't smoke cigarettes, or what will happen. Very graphic, imagery is shown. That is through persuasion, right? The government is trying to persuade you to quit if you are already an addict, and if you're not an addict, to never try that, right? So that is how government persuades. Next, we have through legislation that to prohibit the advertising or promotion of demerit goods. Have you ever seen a cigarette advertisement? No, because it's not allowed. Alcohol advertisement? No, it is not allowed, because the government has legislated that no advertisement should be allowed. Then strict regulations of the market for the goods may be put in place so as to limit the access of the goods, especially by the vulnerable groups such as children. We know that within 100 yards of the school you cannot sell cigarettes and any intoxicating material, etc., etc. Then regulatory controls in the form of spatial restrictions. Example, smoking in public places is not allowed, sale of tobacco to be away from schools, just now I covered, and all these kinds of regulatory controls which are there, right? And no entry in pubs for people who are below the age of 21. There are a lot of other rules like that which are regulatory controls. Next, there is a graph which you can read it in the free time. Then in case of public goods, what will the government do? We have seen in the previous unit that the public goods which are non-excludable are highly prone to free rider problem, isn't it? I told you about the road, and therefore markets are unlikely to get established. So what can the government do? A government can make sure that a provision of public good by the government can help to overcome the free rider problem, which leads to market failure. Excludable public goods can be provided by government, and the same can be financed through entry fees. That is, uh, everything where people might come and do a free ride and spoil a public good or service, entry fees can be kept, and you can make sure that such destruction doesn't happen, right? A very commonly followed method is to grant licenses to private firms to build a public good facility, right? In many of the European countries and US and Canada, it is pretty common, right? All these that public goods and services, or the goods which are commonly used by all, are even outsourced to the people who are in the private sector, and they make sure that the free riding problem doesn't happen, right? Because for government it is not possible to do it all the time. Then price intervention. What do you mean by price intervention? If you leave it to the free market, you know what is going to happen to the prices, right? You have seen farmers protesting on the street saying that their tomatoes doesn't have price, their vegetables doesn't have price. If you leave it to the market, what is going to happen? There are players in the market who are intermediaries. They play with the prices and they make sure that the prices will fall, and it comes at a huge cost, huge life cost of some other people. But private individuals, as we know, they work for profit. So government will come and government will do something called as non-market pricing. That is, if at all you want good, right? A price floor will be price, floor can be kept for a good where the demand for the good is falling very low, right? Let me give you an example. Imagine that tomatoes have come to the market, and the price of the tomato is decided as 2 rupees. Now, if a farmer is there, he will definitely either prone to take his own life or just throw the tomatoes in the street because the price is not there. At that time, government comes up with the minimum support price, isn't it? They say that a price floor is kept. That is, the price cannot fall below this particular limit. Anybody who wants to buy this product, tomatoes, have to buy at this rate. And if they don't buy, government has to buy, isn't it? You can't force private people to go and buy it at 10 rupees when the price is 2. They will buy how much ever they want. Remaining things you have to buy. The government has to buy, right? At the same time, price cap, right? What is the maximum price that can be charged to a COVID vaccine? That was fixed by the government, right? That is price cap. That is, no matter how much the demand is, because in the beginning, the vaccine demand was huge. No matter how much demand there is, you cannot charge more than this particular amount. That is called as price cap, right? There are two things, price floor and price cap, that we learned. Next, how can government intervene to correct information failure? We learned about information failure, right? How can government correct it? Very simple. Government makes it mandatory to have accurate labeling and content disclosure by producers, right? Every, if you look at any of the alcohol packing or cigarette packing or any kind of intoxicating drug, or you can talk about any medicine which is extremely harmful. All these items will have a clear disclosure given by the producer saying that how dangerous it is and what can happen, right? So that is mandatory, made by the government, that you have to disclose. Next, mandatory disclosure of information. For example, SEBI requires that accurate information to be provided to the investors. There are so many restrictions made by SEBI, right? Whereas you have to give quarterly returns, and with that returns, you have to give so many explanatory statements saying that what you're doing, how you're doing, have you earned money. There are a lot of things that you have to give with the SEBI filings, and those things will potentially help whom? The buyers of the stock, the investors, right? And public dissemination of information to invoke knowledge and subsidizing of initiatives in that directions, right? And then regulation of advertising and setting up advertising standards, we have already discussed. And advertising for more responsible, informative, and less persuasive, right? It has to be less persuasive, more informative, and more responsible, right? But do you see that happening on a day-to-day basis? That's a whole different uh, discussion, because I can just give you some fairness creams for that example. Like for a fairness cream, that is, first of all, like you apply that for 7 days and your color will change and all those things. They're not true, yet they are being publicized, and there are certain complaints which are filed also. And as we know, the name was changed of this famous fairness company's product a few years back, right? So we know that what happens, there are consequences to this kind of actions. Next, government intervention for equitable distribution. So what to do for equitable distribution? We have already discussed that in the first unit itself, right? About in the distribution function, about the taxation strategies and all that. If you read these paragraphs, you will understand that this is the same thing which has been repeated over here. right? A progressive income tax, the targeted budgetary allocations, unemployment compensation, transfer payments, subsidies, social security schemes, job reservations, land reforms, gender sensitive budgeting, etc., etc. There are so many things that the government do, and these are called as the policy interventions, right? So next, there is a small concept over here, which is a very important concept, right? That is called as government failure. What do you mean by government failure? Government failure, government failure is not when government loses power. Okay, don't think it that, right? Government failure means where the government intervention in the economy to correct the market failure creates inefficiency and leads to misallocation of scarce resources occur very often. Government failure occurs when intervention is ineffective, causing wastage of resources. At the same time, intervention produces fresh and more serious problems, right? So there was a problem, government went to solve the problem, and whatever resources you used to solve a problem became waste. At the same time, you made the problem worse, right? That is called as government failure. And with that, we have finished the revision of third unit, and we'll be going to the last unit of the revision. This will take another 15 to 20 minutes. So before that, I will have a quick look at the chat box. Right, sir, the diagram of market outcomes of pollution tax, can you explain? I can explain that. That is not a problem at all. Right. So let me explain what this graph is in very brief. On the x-axis, we have output quantity. On the y-axis, we have cost and benefit. And we have this curve over here, which is representing the marginal social benefit. You have to know marginal social benefit, which means it is marginal private benefit plus it is marginal external benefit together, right? Marginal social benefit. And then there is private cost, marginal private cost, which is usually accounted for, isn't it? My raw material prices, my labor prices, and all those things. This give me this cost, right? And the equilibrium was formed here. But the cost which I'm imposing on others was never considered in this, right? The cost that I'm imposing on others is never considered. So government said, wait, you have to include that as well. So government, what did they do? This product, they taxed it. When you tax, what happens? The cost increases. Hence, you come to this line over here. You come to this line over here, right? So what happened? Marginal private cost increased, that is plus taxes. So you will come to the second equilibrium here, that is at point B. So this A equilibrium doesn't work. Now B will be the one. So with that, what will happen? The quantity decreased, right? So because it is a good which is producing lot of pollution or lot of external cost. So the quantity of that good produced reduced, which is a good thing. At the same time, the price increased, which means many people will not be able to afford this now, which is a good thing again, right? So this is how the new equilibrium is obtained with the help of adding taxes for the private for the external cost that this firm is putting on others. I hope that answered your question. With that, I will go to the next unit. Right. The unit 4 is very simple. It's about fiscal policy. All we have to learn is what are the different types of fiscal policies, what are the objectives, what are the instruments, and what are the types, right? So in this, we are going to first learn the objectives. Objectives again are all idealistic points that I'd like to call. That is achievements of maintenance of full employment, maintenance of price stability, acceleration of rate of growth, equitable distribution of income and wealth, etc., etc. Right. Next, we are going to learn about automatic stabilizers and discretionary, fiscal policy. What do you mean by automatic stabilizers? These are the policies which are pre-installed in the economy. Okay, and as and when your economy grows, these stabilizers will start acting automatically, and they will correct the market failure. Any government program that automatically tends to reduce fluctuations of GDP is called as automatic stabilizer. Very simple and apt definition, right? So here, automatic stabilizers have a tendency of increasing GDP when it's falling and reducing GDP when it's rising. It's as simple as that. And at the same time, we have discretionary fiscal policy. What do you mean by discretionary fiscal policy? Sometimes the automatic stabilizers will not work. Whenever the automatic stabilizers will not work, government has to formulate a policy, and they have to implement it discretionarily. They have to come in, they have to formulate, and they have to implement. And we have seen this during what? COVID times. Until COVID times, all the automatic stabilizers used to mostly work. But during COVID, can the normal, economic policies work? No. You need to have special economic policies. You need to have special, provisions to be given to the weaker section. You need to make sure that transportation is there. You need to make sure that the food is there, medicine is there. There are a lot of other things. So the policy was formulated later, isn't it? So that is called as discretionary fiscal policy. And what are the various instruments of fiscal policy? First one, there could be budget as a instrument of fiscal policy. We know that budgetary allocation has a very big effect on the public welfare. Government expenditure, that is nothing but the government spends money on a lot of projects, and where they spend will have a lot of repercussions. In yesterday's class also, I had told you, when a government puts up let us say a flyover project, what happens, right? There is a ripple effect of money, and so much of whenever government spends money, there are a lot of changes which will come in the economy, right? That is again an instrument of fiscal policy. Then public debt. Public debt means what? Government, the debt that the government takes whenever there is no balance in the budget, right? And which will again lead to what? Either reducing money in the hands of people or increasing money in the hands of people. Based on that, the aggregate demand will be decided in the economy. And fourth one, taxes. We already know, right? You increase the taxes, disposable income will be less. You decrease the taxes, disposable income will be more. And based on the disposable income, your aggregate demand will be decided. Based on the aggregate demand, your economy size will be decided, isn't it? So, government expenditure as an instrument of fiscal policy, I have given. Public expenditures are income generating and include all types of government expenditures, such as capital expenditure, public works, relief expenditure, subsidy payment, or transfer payments, and all these expenditures. They include the current expenditures to meet the day-to-day running of the government. They also include the capital expenditures, which are in the form of investments made by the government in airports, in ports, and so many other things. And transfer payments, which are given by the government, which are in the form of pension, in the scholarship, and so many other types of transfer payments which are made. So there are three different types of government expenditure, which might come as a 2-mark question. So please mark that as important. And with that, we'll come to one small concept called as government spending multiplier. Okay, just like investment multiplier. Investment multiplier was change in income divided by change in investment, whereas here it is change in income divided by change in government expenditure. The concept is same, that whenever government increases their expenditure, there is again a ripple effect which is coming, and the formulas still remain the same, right? And the derivation of formula and everything, we have done it very elaborately. We have taken 2 hours or so in the classroom scenario, which is a very extensive discussion, and we can't do that here, right? We just have to remember what we have done, and this you can equate with the investment multiplier, which we have done previously. And then taxes as an instrument to public policy. We know that tax is the instrument of fiscal policy, which consists of changes in government revenues or in rates of taxes aimed at encouraging or restricting private expenditure. You want people to spend, decrease the taxes. You want people to save. You you want people to spend, you decrease the taxes. You don't want people to spend, you increase the taxes. And with that, disposable income changes, people will react very swiftly, right? So that is what it is. Next, there is balanced budget multiplier, which is there. The government budget is said to be in balance when government expenditure is equal to the tax. The change in government expenditure is equal to the change in tax. The balanced budget multiplier is always equal to 1. And the formula is given. And for the purpose of explanation, I have provided this paragraph, which can be gone through very easily. And there is the last one, that is as budget as an instrument of fiscal policy. Government's budget is widely used as policy tool to simulate or contract aggregate demand as required. The budget is simply a statement of revenues earned from taxes and other sources of expenditures made by a nation's government in a year. So what is the budget? That kind of a question is also possible in economics. I will not just ignore that possibility. So that is why this particular line is given. So you just have to remember that. And with that, we will go into the last section of this complete theory chapter, that is types of fiscal policy. What are the two types of fiscal policy? Expansionary fiscal policy and contractionary fiscal policy. It is expansionary fiscal policy is applied when, of course, when there is a recession, right? You want to expand the economy, so you are going for expansionary fiscal policy. And if there is a high inflation in the economy, then you have to go for contractionary fiscal policy. It is like too much of inflation in the economy is also not good, right? So it has to be balanced all the time. So how to achieve that? I have given in 3 lines. That is decrease in government spending. With decrease in government spending, what will happen? The total amount of money available in the economy is reduced, which in turn will turn down the aggregate demand. Increase in personal income taxes or other business taxes. If you increase the taxes, the disposable income will be lower. With the disposable income fall, your aggregate demand also will fall. And a combination of government expenditure and personal income taxes. So you can understand it this way. Government has, I call them as the two blades of the Caesar, right? So there are two things: government expenditure, and there is, income tax or personal income tax, what you would like to call, right? So what will happen here is government will make adjustment to both of this. Imagine that there is a hyperinflation in the economy. When there is hyperinflation in the economy, right, government, which means aggregate demand is very high. When there is high inflation, aggregate demand is very high. You want to get that aggregate demand down, which means you want a contractionary policy. So what are you going to do? You are going to decrease the government spending and you're going to increase the personal income tax. What happens with this? I will tell you. With government expenditure decreased, all the projects will stop. When the projects will stop or projects will reduce, the contracts will reduce, the revenue will reduce. When revenue reduces, what will reduce? The income of the people will reduce. When income of the people reduces, the demand will also reduce. At the same time, if you increase the income tax, what will happen? Disposable income will fall down. If disposable income falls down, the demand also falls down. That is a contractionary fiscal policy, and vice versa for expansionary fiscal policy. So that is with regard to this. Okay, and this is again for a short note. This is again for a short note. This is not all that important. Again, all these idealistic points that I'm talking about, right? These are written over here, which can be easily read and understood. If there is any difficulty in these parts, I will explain. See, I told you about progressive direct tax system as well, right? And also I told you about differential indirect tax. I told you about how GST can be charged at a lesser rate for necessities and you charge it at a higher rate for luxury items and all those things. And okay, this is one of the most important thing in this unit: limitations of fiscal policy. There are different types of lags which are involved. So they can ask about the lag for either one of these lag for 2 marks, or they can ask it collectively for 4 marks, right? So what is recognition lag? The government will not be able to recognize itself what the problem is, right? That is called as recognition lag, right? The government must first recognize the need for a policy change, right? So only when they recognize the need, they'll be able to give it solutions, right? Next, decision lag. That is, you have identified or you have recognized a policy change that it has to happen, but you're not decided on it, right? The decision lag that usually happens, that whenever for example, the various bills which are there in the parliament, I would like to quote one that is about the unmanned vehicles, the drones. Until the very recent past, the usage of drones was not legal in India, right? For certain purpose only it was allowed through certain notification, but there was no bill as such. And it was lying in the parliament for so many years to allow the drones, to be used in India and all that, because there's a lot of dangers also associated with it. And the problem was recognized, but it took a lot of time for the government to make a decision on it, right? So that is called as decision lag. An implementation lag. You decided also, you passed everything, but now implementation is taking forever. That is the one signature move of all the governments everywhere around the world, not only in India. Then there is impact lag. That is, you have implemented that, but you're not seeing any impact. So these are the four different lags, and that is the first point of the limitation, right? 4 points. Then second point is what? The fiscal policy changes may at times badly timed due to the various lags, that it is highly possible that the expansionary policy is initiated when the economy is already path of the recovery, right? So it might so happen. You know that in a business cycle, these phases are timed, right? So basically after one phase, other phase comes. So if you are in the expansion phase, and for the purpose of expansion phase, government put up a policy, but that implementation happened when expansion phase is over and we were contracting, then it can have a ripple effect opposite way, right? Which is very bad in substance. Next, there are difficulties in instantaneously changing government spending and taxation policies, right? There are a lot of difficulties because suddenly you can't say that a certain item is now taxed at 5%, now tomorrow onwards it's going to be double, right? If you give that kind of decision, then there are a lot of backlash in the society, right? uh, it is practically difficult to reduce government spending on various items such as defense, right? It's very easy to say that reduce government expenditure, right? But does it mean that we can reduce the expense on defense and social security? That's not going to happen, right? And public works cannot be adjusted easily along with the movements of the trade cycle because many huge projects such as highways and dams have a long gestation period, isn't it? Right? Uh, Highway project which is extremely long, right? It might take years, like 10 years, 15 years, and with that your phases of economy also might change, right? So it is not possible for us to have that timed perfectly, right? Sometimes there are lags which happen. And the last concept of this chapter is crowding out. I'll give you an example and make you understand what crowding out effect is, right? So you government comes up with a policy that all high school children, okay, will get a cycle. You will get a cycle, okay, to go to school. Now that's a very welcome step, right? Many of the people in the village will be able to reach. If you're living in the city, you might be thinking why cycle and all that. But if you've seen the village India, you must understand that there are still children who are walking kilometers to reach school, right? So if you give them a free cycle, probably they can reach their school on time and their education might be good. So government plan to give cycles. It has happened in states like Karnataka, Kerala, and etc. So, in Tamil Nadu, there are laptops which are given. In Punjab, there are certain other things. In Delhi, also. In Madhya Pradesh, also, there are a lot of things which are given to the students. So, what happens here? Let me just tell you. If you give free cycles to all these people, right, the cycle companies will go down because their demand will definitely come down. So, what happens here is you try to increase the aggregate demand by giving free cycles. Okay, when you give free cycles, of course government will not produce, government will give the contract to somebody else, let us say ABC company, right? So ABC company will produce what? Cycles, and it will sell to the government and government will supply. But here the hero cycle guy was there, right? Hero cycle company was already there and their demand was there. Because you started giving free cycles, their aggregate demand fell down, and here the aggregate demand went up, right? So this compensates each other, right? This compensates each other. Now this situation is called as crowding out effect, right? Where your policy of increasing certain aggregate demand will decrease the aggregate demand of somebody else, and they compensate each other, and overall there won't be an increase or decrease, right? So it will become ineffective. That is the word here. This becomes ineffective. That is called as crowding out effect, right? So okay, so with this we have completed the short revision. Okay, short, how much of a short we say, it's going to be around 1.5 hours every time. So we have finished this. So if you have any doubts, you can put it up in the chat box, or if you watch this video later stage on YouTube, then you can put your doubts on OneFin and uh, in the forums, and we'll be happy to answer all the questions that you got, right? So I will give the next 1 minute. If I see any questions, I will answer, or we will meet tomorrow. Okay. I will dispense for today, and we will meet tomorrow with the third chapter revision, and I'll see you in the next class. Right. So today's revision is ended, and any concepts that I have mentioned in the revision lectures over here are very important, and you have to go through it. And if you have any doubts, you know what to do. Right. I'll see you in the next class. Bye.